Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here, host of the Smart Property Investment Show. I hope you're well. Getting stuck into 2022 and here we are, nearly March. Who would have thought that happened so quickly? A lot of news at the moment. You don't need to tune into any of the different outlets. You'll know there's a federal election underway. Myself up in Darwin the last couple of days for a number of different things, and I had both the Prime Minister and also the opposition leader up there. They were flying the flag. It was for the 80th commemoration of the bombing of Darwin, and they were there obviously politicising everything that's happening on right now. That's a big thing for 2022. Interest rate discussions happening as we speak, and we'll get a bit into that today. Borders are opening up. Fortress Australia just let down its walls, so we're now having international travellers coming back into it without too much restrictions. So that's good to see. So lots going on. And for a lot of different people, they can interpret that. What does it mean for them? But this show, it's a property show. We talk about property investment. What does all that mean for property investors for 2022? You'd be thinking, if you listen to some of the banks, that you're going to start seeing rate hikes by June this year. Who knows? Consensus seems to be August, but probably need to speak to the Reserve Bank governor to see exactly when that's going to take place. We wait anxiously for the first Tuesday of March to see where we're going to go. But the question is where to invest in 2022 and where those risks are, where those opportunities are. We're going to get stuck into it today. We've got our friends from OpenCorp joining us in the studio from Brisbane and Melbourne, and I'm in Sydney, so it is a nationwide podcast. Matt Lewison, he's the CEO, a regular guest on the Smart Property Investment Show, and Michael Beresford, Director of Investment Services. You may remember him. He was on about a year or so ago, and he's back. Michael, Matt, how you going? You well?
Yeah, great, Phil. It's good to be here again.
Likewise, Phil. Good to be joining you.
Yeah, so we've got Brisbane, Sydney, Melbourne. So we're covering the east coast of Australia here in terms of property dynamics. And some people will say, well, Tasmania is part of that as well. And that's sort of bubbling along at the moment, Tasmania. So we don't forget about you, Tasmania. Do not worry. But I do sometimes get criticism that we don't talk about Tassie too much. So we'll do more of that moving forward. And also Darwin. I was in Darwin last week. That was pretty interesting. Again, it doesn't get a lot of information. It seems to be overlooked when it comes to property investment. Matt, you're the sort of brains trust with data down there at OpenCorp or up there at OpenCorp. What do you reckon about Darwin? Let's kick off with that, mate. I'm just interested in what your thoughts are.
Yeah, look, it's interesting because, Darwin, everywhere in Australia has been benefiting from the conditions over the last year. And I think, what do they say? All ships float in a rising tide. And certainly Darwin seems like it's had a good run as well from the perspective of price growth, as has Hobart. Just want to make sure that we don't forget about them. So I reckon anybody who's been an investor in Australia in the last year, whether they're in Darwin, Hobart, Adelaide, Perth, Sydney, would be pretty happy with themselves and very glad that they bought property in or before 2021. So obviously Darwin's been looking good. Now, probably the bigger question is not what it's done in the past, what it's going to do in the future. And that's probably one of the things that is the key now, because we're moving from a market where everything has done well and we're moving into a market where there's a bit more uncertainty. As you said, there's interest rates that are potentially going up. What's that going to do? There's immigration changes and there's markets that are in very different positions. And we certainly expect there's going to be some of that divergence moving forward. We're going to see some markets really outperform others, and parts even within certain cities are going to perform well, while other parts are going to underperform. So, I don't want to tarnish any particular city, but certainly the fundamentals in Darwin right now probably aren't looking as strong as some of the other cities, just in terms of vacancy rates currently and stock going to market and turnover.
I completely agree with you there, Matt. And the best investors I know are the ones that are able to sort of disconnect with the noise or the emotional connection they have with any particular area. the best investors will put their money in the right asset at the right time that's going to get the best outcome for them. But what it reminded me, sort of heading up to Darwin and having a good look around, was the value of looking beyond the data to get the ground truth. I really enjoyed traveling around Darwin and looking at the market up there and seeing what's going on, and just really giving me a sense for the realities of different sort of cities, different capital cities or different locations. And Darwin itself it's a nice place to live. It's hot. I'll tell you that. It's the wet season right now. There's been a lot of development around the waterfront. There's a lot of apartments have gone in. Not a lot of transactions taking place, which I found really interesting, but just really give me a sense for that area. Palmerston City to the south of Darwin, I had no idea the significance of that particular area. And it's either already or it will be much bigger than Darwin in time. It's a huge area right there. So able to calibrate myself and get the ground truth, actually the reality of looking at property markets up there, irrespective of it's Darwin or whatever. If you're investing in property, sometimes it's worth actually getting boots on the ground and having a look around.
Oh, I couldn't have said it better myself. I think sometimes getting out, and that's the one downside of the last couple of years. It's been a lot harder to travel, drive around, see what's getting built, the infrastructure, new shopping centres and things like that, and opening your eyes up to different areas. But yeah, it's I think one of the great things about property is that if you have a bit more knowledge than the next person, then you've got a much higher opportunity or probability of making money if you're better informed. And part of being informed is sometimes, as you said, getting boots on the ground and even talking to the people in the market. So I was curious to ask, actually, when you were in Darwin, what's the word on the street? Like, what's their view of the market?
Well, it's funny, Darwin, and I'm sure this probably lends itself to your skill set inside of OpenCorp. Matt, there's a whole bunch of moving parts up there at the moment, and a lot of it is political. A lot of it is strategic as well. Darwin is really the centre of the Indo-Pacific right now. So strategically for Australia, it's a very important area. You've got considerable amount of investment up there in terms of defence spending. If you want a job and if you're a tradie, go to Darwin and you'll be able to make yourself a good earn up there. I'll tell you that for nothing. But it's a whole bunch of moving parts up there, whether or not the government is supportive of growth, accelerated growth. I think they are. The nuances of the market is considerable, but it's, who knows? Like, I can't see Darwin doubling in size or the Northern Territory doubling size in 10 years' time. I think it's hard living up there. It's a very transient population. People sort of spend their time in Darwin and leave. And I think as a property investor, is that a good thing? Maybe if you've got good investment property, there's always going to be people moving in there. But I can't see accelerated population growth up there. And for me, that's probably a big thing as a property investor. But the sage reminder for me was go and have a look around. When you hear about Darwin or you hear about that particular area, it's good that we can concentrate on Darwin a little bit, but you hear all this noise around the Chinese port up there. You know, actually going to have a look at that, I was pretty underwhelmed. I went, is that it? Is it like, if for some reason I thought it was going to look like, you know, botany or whatever, you know, but it's literally, you know, you can park up a boat, you know, maybe two if you're lucky. It wasn't a significant architecture, or wasn't a significant engine that I thought it was going to be. I was like, wow, that's pretty underwhelming. Yeah.
And I think that's isn't that the concern for government, was that it was just a strategic asset for a Chinese entity, perhaps. And I mean, we're all kind of well and truly in the outer stands of the sidelines when it comes to seeing the inner workings of government and all those geopolitical issues going on. So we have to take things at face value at time. But yeah, look, I think probably even Darwin, when you talk about population growth, I mean, Darwin's really often led by the armed services decision. Yeah. So if the Australian government decides they're going to send in more troops and they're going to build out an army base and kind of add to that, then absolutely we see a big spike in population growth. Generally pushes up rents, pushes up prices, but they tend to be intermittent as opposed to a steady escalation in population, which, as I said, it kind of goes up and down, which I would have thought a few months ago, probably 6-7 months ago in Darwin, vacancy rates were low. There wasn't a lot of stock on the market. We've seen, without kind of any major changes, the new stock, or the amount of stock hitting the market, weekly rental listings are going up and prices have started to plateau as a result. So it is, I guess, the size of the city means that it can change direction reasonably quickly. It's one of the great things about Sydney, I suppose, and even Melbourne. They're really big cities, big population bases, and the wheels turn slowly at times. So it takes a a while to build up momentum, but it also takes a while for that momentum to switch off, which kind of gives a bit of comfort and confidence in, I guess, in making investment decisions.
Yeah, and for Darwin, and you see it elsewhere, but for Darwin or the sort of the northern end of Australia, you're going to see considerable investment moving forward in terms of defence spending. All the bases up there are getting huge investment put into it. Again, that's good for jobs and growth and all that sort of stuff. You've got the marine rotation happens through Darwin. They need places to live and everything that's surrounding it. You probably see more of it moving forward. For me, Darwin's, it's there to watch, but it's still a tough town to live in, right? I don't know. I can't get it. But this is sort of like, all these different things moving on. We talk about Darwin, you're talking about geopolitics, you're talking about how that's going to shape property markets. You look at sort of as Australia moves out of the pandemic, how things are going to move moving forward. You've got sea and tree changes, people moving to regional areas as a result of more flexibility with work. Who knows what's going on? And this market, more than probably anything that I've been involved in some time, is a little bit more precarious because no one yet knows exactly what's going to happen. Fix that in with interest rate changes and all that sort of stuff, elections and whatnot. So, the strategies that worked last year probably aren't going to work as effectively in 2022. And that's the question I have for you guys today. And I know you're about to release a report over the next week or so, your Q1 2022 market insights. This is something you guys release quite regularly. Matt, is that one of your babies? You sort of steer that through OpenCorp?
Yeah, look, it's something we've had for a long time, but it's been an internal document. So we developed that for our investment committee, for our investment decisions, and the investment committee of our fund, Resi Fund, to ensure that we're forward-looking and we have a really we're ground truthing, I guess, our decisions. But I mean, the things that are at play, you touched on a few of them. You've got interest rates competing with rental vacancy rates, and unemployment versus immigration. And there's so many things that are kind of balancing off against each other that it does make it really hard to predict. I mean, if interest rates, there's obviously talk about putting interest rates up, but at the same time, we've got rental vacancy rates at almost all-time lows nationally. So, well, if you put interest rates up and you turn off some investment in housing, then you most likely, or the RBA would kind of need to know that they're likely impacting rents that people are going to be paying in the future, because all of a sudden in a year's time, there's less new stock coming to market. The tenants are paying more, and it's a big challenge for them to balance those things off. But it's probably not the first time we've seen uncertainty like this. And I know, Michael, it was probably, 2017, we saw a similar situation in Sydney and Melbourne where there was changes in the financial regulation and created a lot more uncertainty, but there were still winners in the market.
Yeah, I think you guys have mentioned the term fundamentals quite a lot already in the conversation, and that's something that we're always talking to our clients about and investors about, trying to help them stay focused on what those fundamentals are. Affordability is obviously a key one. Demand and supply are the other major two. We were seeing situations in Melbourne 2016 to 2018 where clients had bought, just before these lending restrictions came in, or those that could service, even once those announcements had happened. Because I think it's important to remember the lending restrictions weren't a single decision. It was a phasing on of increased restriction between 2015 and early 2017. And those clients that, for example, were buying in Melbourne in different pockets, we were somewhere between 450 and 550, depending on land size. Those properties today are 750 to 900, depending on land size. So, that's a relatively short time frame where property is concerned. And within that time frame, it hasn't just been lending restrictions, but obviously COVID as well. And if you lined all of these potential negatives up, or potential impacts to the property market, and paid attention on those as opposed to the fundamentals, then you would have missed out on a lot of growth in that time.
Yeah, a lot of this is covered off in your Q1 2022 Markets Insights. So that's Jan to March this year, where to invest in 2022, risks, and also trends to keep an eye out for. You can download it just in the show notes. You should be able to track it down, or just Google OpenCorp Market Insights report. You'll be able to track it down there, download it and check it out. But one of the key sort of questions I have around it all, Michael, is, in your sense, you've been at this for a little while, how is the market looking right now compared to previous cycles? If you're a first-time investor, would you be looking at property as an asset class thinking this is something I need to be involved in, or potentially I've probably missed it by a couple of years. I should have been in that sort of 22, 25% cycle of growth that we've seen over the last year or so?
Yeah, it's a good question, Phil. And I guess one thing I've learned over nearly 20 years in property is the best time to buy was 20 years ago. The second best time is as soon as you can. So it's really important when considering property investment to do it well. You need to be taking, a long-term approach. And if you take a long-term approach and you focus on those fundamentals, then it's a pretty good recipe for success. So, when we consider, as Matt was saying earlier, I think the most important thing to consider for 2022 and beyond is that we're not going to see. We had a really rare occurrence last year where all of the four major capital cities saw upwards of 13% growth in a 12-month period. It's far more typical for markets to go through cycles and for some to be growing while others are growing strongly, while others are growing moderately, and others plateauing or even contracting a little bit in terms of median house price movement. So I think it's important to remember that 2021 was a bit of an anomaly in that regard. Moving forward, what we're going to see, I think, is that some investors will do really, really well, versus others that probably won't do so well, depending on what they focus on and where they choose to invest. So what is always fundamental is by focusing on these fundamentals, it ensures, as you said before, looking at the right asset in the right location at the right time of the market. That's the formula. What we're seeing in terms of people that we're speaking to just in the last 6 to 12 months is, especially in Sydney, as affordability constraints have really started to bite, that people that were typically, more comfortable only looking within the suburb that they live, now kind of accepting and understanding that there are opportunities, more broadly than that. There are different locations within the capital cities that they live in, or even more widely different capital cities around Australia that provide, really good opportunities because they're markets that haven't seen the same kind of growth. And I'm talking about, still parts of Brisbane, absolutely. Don't focus so much on the nearly 30% that it's up. It's just starting at cycle compared to Sydney and Melbourne that are up, 90 to 100% at a maximum in the last 8 years or so. Perth as well, obviously, very affordable and rents up dramatically. I know I've seen my property in Perth, the rent's up $145 a week since March last year. So, there are absolutely markets that provide great opportunities for investors if you're focused on the right kind of things.
Yeah, and the equation isn't difficult, as you mentioned, Michael. It's about deploying your money at the right place, the right time for the right reason. And that's the art of property investment. I agree with you also that best time to invest is 20 years ago. The second best time is today. But 2022 will be different to 2021. You cover this in your Market Insights report. Just want to get into some of those drivers. Before we do, Hannah, I just want to go to a quick break. Stay with us. Back in a moment.
Looking for a blue chip Gold Coast investment property, or trying to relocate to the beautiful sunny Gold Coast but keep missing out on the right properties? Maybe you need an expert on the ground to source the right property for you. The Srama Group are the leading recommended buyers agency specific to the Gold Coast, providing their clients with exclusive off-market property opportunities, specific insights into market, combined with a large network of dedicated professionals to ensure you make the right decision without the hassle. Get in touch with us at thesramagroup.com.au and secure your financial freedom today.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show. I'm with Matthew Lewison, CEO, and Michael Beresford, Director of Investment Services over at OpenCorp. Now, the question being, Matt, I think it's going to be different this year to last year. Can we get the same growth? I think most of the banks have indicated that growth will slow this year compared to last year. These are the same banks that told us 2 years ago that property's going to drop by 40%. I'll just flag that. But what's going to be the key drivers in this market in 2022, and how is that different than 2021?
Yeah, I think it's the $1 million question. Michael touched on it a little bit. Affordability is going to be key for a number of reasons, as if there is a risk or if interest rates do go up, then serviceability is going to bite, and it's going to bite on the prestige properties and the higher end properties first, where you need a lot more to get in. And banks are already starting to get wary of over-lending into those markets. Now, the great thing about perhaps whether it's Sydney or Melbourne, some of their inner suburbs, even not necessarily the prestige suburbs, but just middle ring suburbs, have done very well, and they're well above the median house price. They've created a lot of equity they're not likely to go up as much in the next 12 to 24 months because they are obviously pushing into an area where it's not as affordable or a price point where it's not as affordable, and any interest rate changes might impact that. The other thing that interest rates would do in those markets is, what we know is that as interest rates go down, share prices often go up. And the inverse can be true as well. As interest rates start to go up, obviously dampens share prices. We've seen the share market in the US come down about 10%. Now, when that happens, it obviously starts to impact the owners of shares. And while there's obviously a lot of big funds, it's largely the people in the inner suburban areas in the prestigious suburbs who are impacted through bonuses or obviously seeing their wealth change. So we're expecting to see those prestige markets being some of the toughest in the next 12 months. But the affordable suburbs are going to have a lot of pressure because we're seeing immigration starting to pick up again. We're expecting that the surplus vacancy in Sydney and Melbourne, which is largely a phenomenon of the high-rise apartments and the student accommodation and kind of areas around universities, we're going to see that wash out as students start to fill those bedrooms again. And we're also going to see as new skilled migrants move into Australia again, and we expect that that's going to be at very high levels once again for a range of different reasons. But that's going to put upwards pressure on rents, any of the affordable suburbs, and it's then also going to put upwards pressure on house prices where there's affordability. Now, what's affordability in Australia is probably the next question, and it's different in every city. But I would focus for investors, the cities that have got the best fundamentals of affordability right now, as well as low vacancy rates, low stock coming to market, and constraints on supply. I would say it's anything in Southeast Queensland, so Sunshine Coast, Gold Coast, Brisbane, even out to Ipswich, where it's very affordable right now. Perth, the northern suburbs, southern suburbs as well. North, you're going about 40 kilometres north of the city, or even northeast. South, you can still get an affordable property about 20 kilometres south of Perth. And even in Adelaide, the fundamentals look pretty good in Adelaide. Now, the one thing I would offset that with is that Adelaide's grown its population around the same as a number of the other cities in Australia, which means that it hasn't really grown a lot in the last 24 months. Now, generally, when there's open international borders and there's lots of migration, we see that filter into Melbourne, we see it filter into Sydney, we see it filter into Brisbane, and we see it filter into Perth. We don't see as much population growth in Adelaide in the long term. So right now, fundamentals are great. Where do we see the immigration going in the future? I would expect that's going to be Southeast Queensland and Perth, Sydney and Melbourne over Adelaide, which is obviously going to mean that maybe 12, 24 months out, it won't be quite as strong as Perth may be. Now, I haven't really touched on Hobart, Darwin there. They, again, haven't had as much of the benefit of net overseas migration in the past. And Canberra is obviously very, very tight market, but affordability is not as strong in Canberra as it is, or in the ACT, as it still is in those other cities that I've mentioned, which we think are going to get a lot of investment over the next 24 months and still have a fair way to go in their price growth. So, yeah, I think, as I said, there's some of the major drivers. And then there's interest rates. And that, again, you've touched on, obviously, what's the outlook from banks or the RBA. It's a really tough one to predict because what we have seen in the US is they've started putting their interest rates up. In the last quarter, new purchases of homes has dropped by 10%. Now, when the US puts up their interest rates, everybody locks in interest rates for 10 years. So if interest rates go up, it only affects new home buyers, not existing home buyers. So they generally go a bit harder perhaps than Australia might have to, because if interest rates go up and most of the market's on variable or on fixed rates that'll come off in the next 12 and 24 months, then they don't need to adjust that lever very hard to see, obviously, across the economy, people start to change their buying decisions, not just about property, but the consumer goods as well. But I kind of offset that with the only reason they're going to put up interest rates is to dampen inflation. I think property makes up about 26% of the CPI bucket or thereabouts. Chunk of that is for rents. So you go, if you put interest rates up, is it going to reduce rents? Probably not. It'll have the opposite effect. If they put interest rates up, if they're doing it to dampen house price growth, well, it's probably not going to be as necessary because we anticipate Sydney and Melbourne, which makes up 60% of Australia's market, is going to have less price growth this year anyway. And if they're doing it to take the pressure off prices of supply, well, it's going to have a very, very blunt effect on that, because prices of timber, steel, and all of those, most of the goods that we have to import are actually being driven by offshore and forces outside of Australia's control. So it will be interesting to see how they play it, but certainly the language from the RBA is still fairly passive around interest rates. So
yeah, I think passive is a fair way to put it, and it's been beaten up a lot, interest rate rises moving forward. And we think about, 2021 versus 2022, what worked last year versus what will work this year. Last year, we were investing in property on the basis that there shouldn't be interest rate rises until 2024 is what the RBA or the market was sort of saying back then. Now they're sort of saying, is it June? Is it August? Who knows? A lot of it's going to be connected in with wage growth. And the RBA governor has made it pretty clear that he's not going to tinker with rates until he actually sees real wage growth. How and when that happens, who knows? The unemployment levels are pretty low. But for you, Michael, your job at OpenCorp very much is interpreting the great sort of scientific data work done by Matt and his team and applying it into investment strategies for property investors. With this sort of under the shadow of interest rate rises sooner rather than later, how will that shape the way investors buy property in 2022 versus 2021? Does it really matter that much? And to your point, the best time to invest in property is when you can. Should you do it in isolation to what will happen when interest rate rises?
You took the words out of my mouth, Phil. Does it really matter? I think to my point before around long-term buying, prudent financial management is you shouldn't be buying a property if you can only afford it today and not factoring in buffers or, what if interest rates go up because we're at record lows? Who knows exactly when it's going to happen, but guaranteed it will at some point. They can't stay this low forever. But the main thing, and it's without doubt the most common question that we've been fielding in the last 2 or 3 months from talking to potential investors and talking to clients. But I think the way that we explain it to clients is this: it's actually quite simple. Interest rate rises, and I guess the fear that can generate typically comes from the fact that the mortgage that most people have is the mortgage on their own home. And as a result, the full brunt of any increased cost by an interest rate rise is borne out of post-tax income, where people have to cover 100% of that increase themselves. If we think about the investment landscape, however, interest rates don't just go up because it's Tuesday. They go up in response to a range of economic factors that have occurred. And if interest rates are going up, then economic growth is up. If economic growth is up, job creation is up, unemployment is down, wage growth is up as well. If wages are up, typically property prices are up and rents are up, and so on and so forth. So there are a lot of positive effects on interest rates going up. And it's why, while our clients look at me a little bit funny when I say this, I like it when interest rates come down because your portfolio's cheaper to hold. I love it when interest rates go up because if the rent's gone up and wages have gone up, and therefore tax benefits can offset the vast majority of any cost increase due to an interest rate rise or two, then I don't know too many people that wouldn't be happy to see a couple of $100,000 in growth for another $10 or $20 a week out of pocket, especially when a lot of properties today, or at least I guess the smart acquisitions are well and truly cash flow positive today anyway. So that's, I think, the perspective to keep on interest rates is always budget, when you're looking at investment decisions on a higher rate than what they are today, because they will go up. But there are a lot of positives to come from come for the property market as interest rates rise and the wider impacts on the economy.
Yeah, and that, Michael, is the information you're not going to read in your sort of more tabloid media. They'll be talking about interest rates going up. Australians are going to struggle because they need to pay X $100 more a month on their mortgage, and it's going to impact everyone and everyone's going to go broke. The very mature way to look at it is if interest rates are going up, that's a indication of underlying health of the economy. And if interest rates are going up, guess what? For property investors, your rents are probably going up as well. So a whole lot of things moving in unison. So it is positive in some respect, depending on how fiscally responsible you are in being able to manage your portfolio, and there's good outcomes for people as a result of it. So don't get carried away too much when you hear about interest rate increases, because it's one of those things, every action is an equal and opposite reaction. There's typically more income coming in your back pocket as a result of interest rate rises.
I think you're spot on, Phil. I think the other thing to bear in mind, and to shield yourself sometimes from the sensationalist headlines that are there to sell papers and clicks. That's what the tabloid media is there to do, and they do it very well. Just remember that anyone that's borrowing money today, regardless of whether it's 400,000 or 4 million, the servicing calculators that the banks are applying, factoring in interest rates being 3% higher than what they are today. So the talk out there around if interest rates go up 0.25%, then all of a sudden, there's going to be mass sales and mass supply on the market is unfounded, because interest rates could go up 3% tomorrow, and anyone that's borrowed money can still afford to repay it in the bank's eyes. So I think it's important just to keep some perspective on that there are, while the actual cash rate and retail rates are low, a lot of buffer has been built into the prudent financial management among APRA and the banks of late especially.
One of the really interesting things, which I'll throw out there too, we've seen this in the US in the last 6 months as well. As interest rates started to go up, there was a big spike of purchases initially as people wanted to get in, lock in their rate. In 2007, as we were going through an interest rate rising cycle, there was obviously the RBA didn't know that the GFC was coming, so they were trying to put the brakes on the Sydney and Melbourne housing markets. Prices actually escalated faster as they put up interest rates for the same reason. People want to try and get in while it's cheaper and lock in those interest rates. So again, if we do see interest rates starting to shift up, or that RBA message starting to change from a passive to maybe a little bit more restrictive, then I wouldn't be surprised if we start to see another rush, which will, again, for those that are in the market or thinking about whether they should get in the market now or wait, obviously, if you're in the market and that rush happens, then you're going to get the benefit of that. And then, as Michael said, you get to get the benefit of increasing rents over time. And I'm pretty sure, I saw the stats yesterday, 70% of our clients' tenants' portfolio in the last 3 months has had rents put up. And the average rent increase is over $30 a week. So we're kind of already seeing that there's upwards pressure on rents, and that's going to continue.
Think back to the GFC and how Australia fared versus other parts of the world, in particular the US, was really good. A lot of it due to the sort of prudent way that our banking system has been created. And to your point, Michael, sensibility is structurally factored into the banking system in Australia. Banks don't lend money to people if they can't afford it with a buffer involved. So most people should be able to absorb increases to interest rates. Is what happens subsequent to that? Will it stop people buying, or will it prompt people, to what Matt was saying, to buy faster and you get another uptick? Who knows? We'll follow that through. There's a lot of moving parts right now. And I really want to understand, there's places which are good places to invest, and there's probably markets it's worth avoiding. I want to get into that. We'll just go to another quick break. Stay with us. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back. Phil Tarrant from Smart Property Investment with Matt Lewison and Michael Beresford from OpenCorp, regular guests on the Smart Property Investment Show. So the question for me, Matt, is, considering the interest rate dynamic, considering the emergence of Australia outside of the COVID pandemic, considering the opening of Australian borders and migration potentially coming back in Australia, or at least getting tourists into our restaurants and other places, stimulating the economy. Is there going to be more money washing around in Australia moving forward? I would think so. But that doesn't mean every single market in Australia is a good place to invest in. Is there anywhere that you'd be sort of avoiding at the moment, markets and or regions in 2022?
Oh, look, I think it's a great question, because I think over the last 2 years, there's been some regions that have performed exceptionally well. And we saw, and there was a lot of media around the city slickers moving out into areas like Ballarat, for instance, which was a large regional city, only an hour's drive from Melbourne. Other cities within an hour and a half of Melbourne and Sydney did really well through that period, and actually wasn't because, like the data's shown now, it's not because of so many people moving from the city out to those areas. There was certainly a bit of that. It was also because the teenagers and the young adults and the people who maybe otherwise would have moved to the city chasing a job stayed put. So the vacancy rates got squashed. Rents started to go up. Prices started to go up. Now we're starting to see people move back into offices again and more jobs opening up again in the city, hospitality and the like starting to get turned back on. So there is a risk that that's going to lead to a reversing of that trend with people starting to move the other way while there's a bit of a construction boom happening in those regional cities. I'd say one that I would look at in the opposite, where I think it didn't benefit as much, but it may benefit this year, is Toowoomba. If you're looking at regional cities, Toowoomba, hour and a half drive from Brisbane, still a lot more affordable than Brisbane. And I'd expect that this year it'll probably perform well. Now, I caution people because I also say if you're looking at that, look 24, 36 months into the future and what does the trend look like there. If you were chasing short-term gains, then maybe that could work for you. But if you're looking at long-term and you're going to be holding a property for an indefinite period, then you really need to look at that 36-month profile, which is really why we tend to move back to the cities with more than 200,000 people within kind of an hour's drive of a capital city, and where there's a lot of different employment generators and there's going to be ongoing demand, and also where the skilled migrants will want to move to. And yeah, I think, again, I mentioned them earlier, but obviously the Southeast Queensland trio of Brisbane, Gold Coast, Sunshine Coast, Ipswich is exceptionally affordable right now. And despite the fact there seems to be, when you look at it from a map, there's a lot of land around Ipswich. It's coming out of the ground very slowly. And so we're seeing, obviously, that putting pressure on prices. Townhouses in Brisbane, especially, I mean, we've seen townhouse prices go up 30%. We see townhouse prices before the market sees townhouse prices because we're also a developer. We know what prices we're likely to be putting on townhouse projects that we're going to be developing. And we've got some sites in Brisbane, and we're expecting that we'll be putting them to market probably $150,000 above where the previous market was looking. And that's just because there's no stock. And so we've seen across Brisbane townhouse prices go from $600,000 as an affordable townhouse. They're now at $850 to $900. Anything in that sort of kind of that pocket of Gold Coast, Sunshine Coast, if you can get a townhouse under $650, under $700 on a decent sized townhouse with good finishes, you're probably going to be doing very well. And again, if I was looking in Sydney, for instance, we actually really like that southwestern pocket of Sydney where there is still a lot of infrastructure coming through supporting the new, is it the Aerotropolis? It's got some fancy name. Sounds like
it's everything. Everything in Sydney is fancy, Matt. It's definitely fancy. The question, Matt, around that's interesting to hear about townhouses up in Brizzy. For me, looking at sort of opportunities for 2022, but sort of markets or regions to avoid. Your concerns, I know you're developers, but your concerns around the hike in building materials and costs at the moment. If you're developing in this market, the numbers that you probably put together a year ago in terms of feasibility are probably very different to where they are today. And I see a lot of people, and running in parallel with this, the slowdown in new builds, because builders are actually just finding reasons why they don't want to actually build properties at the moment because they're on fixed price contracts where they just go, oh yeah, it's a 3-year waiting list to build a house right now. So this is a big problem, isn't it?
Yeah, we look, absolutely spot on. There's 2 things, maybe 3 things that have happened in the last few years that are helping to cause that significant escalation in prices for townhouses. One, a couple of years ago, Brisbane City Council made a decision to make it a lot harder for a developer to get a townhouse approval. They just said, we don't want townhouses. So all of the little infill sites kind of got ruled out. So that means there's less supply coming through. Then you've got construction costs going up. So developers aren't going to bring stock to market unless they're going to make a profit. So if they have to sit on it for longer until prices go up, they will. We also saw Brisbane City Council change the planning scheme on apartments to increase the number of car parks that an apartment building needs to provide. In some cases, it's gone up by 80, 90% in terms of car parks. So it's adding $100,000 per unit to the cost of construction. So how does that play out? Developers just aren't bringing their sites to market. They're just sitting on them and they'll wait until prices go up. We've seen in Perth some apartment developers sell out of a project off the plan and then park it and not build it because it costs too much to construct right now. So those things in the infill market are really cramping the ability to bring new supply, which is obviously when you can't bring new supply to market and you've already got low vacancy rates and rents going up, it's going to keep that upward pressure on the market for at least 24 months. We can't see that kind of turning around at all. Hence the reason why we're very bullish on if it's sort of under Australia's median house price and you can get a townhouse or a house and land package in that market in southeast Queensland, because the market can't create new stock at the rate that there's demand, you're going to most likely do very well in the next 12 and 24 months.
It just reminds me of the layered complexity of investing in property in Australia. It's like, where do you say? Hence the reason why you think you guys have the business that you have. Michael, for you, do you think regional areas will outperform the cities this year? And to what Matt said around these sort of areas and our regional hubs an hour outside of the CBDs, are they regional or are they just quasi-metropolitan these days? Who knows? I don't know where to start and stop with this, but your thoughts on regional areas or what constitutes regional moving forward?
Yeah, well, I think the regional areas is an interesting one because there's obviously a lot of talk about people moving out to the regions, but the data suggested it was a fraction more than what it had been. I'm talking about 5,000 more people nationally than the year before. It's really a negligible figure. And as Matt talked to, it was more the existing population of the region staying that caused the restriction on supply than it was a mass influx of population out. And, just in casual conversation that I've had with a few people that live locally to me, it's already people that, made that reactive decision to buy a lifestyle property, realizing that in the last 3 or 4 months, they really haven't used it very much. And was it a smart decision? I think we'll start to see some of that adjustment happening as well. So, not everyone will be doing that straight away, obviously, but if you're after, consistent performance from your portfolio, there might be some regions that do very well for a short period of time. And it's very hard picking those locations and picking exactly when they grow and when they grow quickly and when they'll stop and getting your timing, perfect. So focusing on those larger hubs within, an hour or so of a major capital city and the major capitals themselves, we think is a far more reliable way to go in terms of capital growth and low vacancy rates and rental performance.
So, and I'll conclude with this question, Matt. When you look at 2021, everyone's they're going to go, wow, it was great that I was in the market in 2021 and I got 20 to something % uplift in my property values. I'm a genius property investor. And these are probably going to be the next generation of buyers agents, right, who think everything they touch turns to gold. We've seen it all before and it doesn't necessarily work that way. But if 2021 is going to be identified with that, what do you think 2022 is going to be identified as?
I think the people who, at the end of 2022, we'll look back and we'll hear some horror stories perhaps from some people talking down, like maybe not being as enthusiastic about their experience. And we're going to have others who absolutely will be patting themselves on the back going, yes, I made the right decision for 2 reasons. One decision was they decided to buy in 2022 when there was still growth. 2, they decided to buy in the right place. And I think the right place is absolutely critical this year, more than the right thing, because if you're in the right place, and we've talked about it a few times today, those fundamentals of like low supply, very tight vacancy rates, rents increasing, pressure on prices. I mean, it's not rocket science, that part of it. If you have that mixture of ingredients, you're going to see price growth, even if there is a potential increase in interest rates. So I think the people at the end of this year who make money in property can pat themselves on the back, and hopefully the others learn a lesson from it.
Sounds like any other given year, Michael.
Pretty much. And look, one thing that Matt mentioned about half an hour ago, that just having some really positive stories in years gone by. Matt talked about the prestige markets in especially Sydney and Melbourne maybe starting to feel a bit of the pinch with regards to demand and affordability. For those listeners that have got property in those markets, the one thing that I'd really encourage them to do is use the growth that you've seen already. Be a little bit ahead of the curve based on the growth that's been seen, get your property revalued, extract any equity that is available. We saw clients do, especially Sydney-based clients, late 2016, early 2017, take that kind of guidance. They'd seen, 80 to 90% growth in their house price in the 5 years prior, extracted that equity and were able to buy multiple properties, 3 to 5 investments off the back of that growth, only for the median to then correct over the next 18 months by about 15%. Now, had they waited 3 months, it was probably 1 or maybe 2 investments they could have got. Those extra 2 investments by being able to unlock their equity and taking that action has well and truly paid dividends 5 years later. So, it's not just about what the market's going to do. It's understanding where you are and where your assets have performed and why, how you can capitalize on that and position yourself, moving forward to take advantage of the opportunities out there, right now.
We just covered off some of the info, and thanks for the sort of pre-publishing insights. It's good to get it first in your 2022 Q1 2022 Market Insights report. So this is from OpenCorp from Jan to March this year. You can download it in the show notes wherever you're listening to this right now. You can also just, if you go to the OpenCorp website, you'll be able to download it there, or just Google OpenCorp Market Insights report. You'll be able to download it. That'll be available by the time that you listen to this podcast. That's just a little bit of a taster about the sort of stuff in it, but it's a pretty big report, isn't it, Matt? There's no shortage of info in it.
I think 83 pages in total. So people who decide to read it will be forgiven if they don't read every page. Obviously, there's parts of it that are going to be more relevant to than others. But as I said, it's a document we use to drive our own decisions as well. So hopefully it can be put to use by other investors.
Sounds like a pretty good asset. As Matthew Lewison, CEO, and Michael Beresford, Director Investment Services, OpenCorp. Gents, thanks for your time.
Awesome. Thank you, Phil.
Thanks, Phil. Always good to talk.
Nice one. Now remember to check out smartpropertyinvestment.com.au. Plenty of info like this from leading experts giving their insights on what's going on with property, how you can make more informed decisions. Social media, Smart Property HQ is where you'll find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to refinance your loan for a better rate? Maybe you're considering releasing equity to grow your portfolio, or struggling to find a lender that can meet your needs. Finny is the investment finance specialist that has the solution. With access to over 70 lenders, Finny can track down the financing solution you need. We specialize in investment property finance, and we only deal with lenders that have the right solutions for investors just like you. So you're in safe hands. Fast-track your investment strategy today. Visit finny.com.au for more information.